So social media may have skewed your view on what real trading is. And in this video, I'm going to dispel some myths, break down some common misconceptions, and give you a thorough trade plan for the next 12 months through 2026. So let's dive in. Now, you want to become profitable in 2026, but I'm going to show you what you're likely doing wrong, why you're not profitable so far, how you can fix it, the correct way to trade, which has probably been skewed by social media and other influences, and a solid plan for the next 12 months of trading. So the first thing we need to look at is setting your expectations. And the reality is, these guys are making more money selling courses than they ever have trading. Now, I can't say with complete definite proof, but I don't even know if these guys actually do trade or can trade. All I can tell you is that their results are very far-fetched and completely unrealistic. And they're being pushed to sell a service, a course, an algorithm, whatever else. Now, I'd be lying if I didn't say that I make money from teaching, because I do. But I'm trying to show people what real trading is and cutting through all the bullshit that you see on social media. So what is real trading? Real trading is consistent, steady growth over time with an emphasis on sound risk management. You can see over 2021, 2022, I kind of average returns on the month for around the 3 to 5% mark. This is one of the best runs I've ever had as a trader, with 118% return over 2 years. And at this time, I was pushing risk pretty hard. I was taking some trades at 2% risk, and I very rarely do that now. I'm always below 1%, because as I progress and grow as a trader, my main concern is always my risk management. So let's take a look at an example of some of the best traders or the best funds ever. Well, Jim Simons largely is regarded as one of the best traders who's ever lived. And you can see that his net annual return after fees was around 39%. That's an average from 1988 to 2018. And this is often considered the greatest trading record in history. Now, Jim Simons had a heavy use of mathematics. He was an MIT graduate and by all accounts a genius. But his performance here is considered so extreme that it's unrepeatable under normal market conditions. So when we look at the trader turning $100 to 1 million, we have to consider that that's 7,200 times Jim Simons' annual return. So the trader on YouTube turning $100 to 1 million is beating the best trader who ever lived's annual return by 7,200 times. My grandma always had a saying, if something sounds too good to be true, it probably is. I think this is the prime example of that. Now, I'm not saying flipping accounts isn't possible, because it is, and I've done it before, but it is not realistic trading. There is a very high risk of ruin. What do we mean by risk of ruin? There's a very high chance that we are going to blow the whole account, and you cannot be considered a risk manager or a money manager or a long-term consistent trader doing those things. So it's really important that as we go into the new year, you set your expectations correctly and you understand what actual real trading is. So if we look at a few different trader types, a passive investor, so on a good year, the S&P 500 will give an 8 to 10% return. That's a good year. That's passive investing. Now, you shouldn't even consider trading unless you can beat a passive investor's return, because there's very little point. A skilled retail trader can do 10 to 25%, often with high volatility. Professional fund manager who will be earning 7-figure bonuses maybe does 15% in a year. That's a phenomenal year for them. And really that elite legendary status, the 20 to 30% per year, is fantastic returns. Now, I know someone that manages a family office that's done 36% this year, and this is the best year they've ever had. And this person is an ex-institutional trader, worked on the floor of the CME, and has achieved fantastic results. Now, many retail traders are chasing that 50 to 100%, even more. They're seeing videos like the $100 to $1 million, and they're chasing thousands of percent. But those returns usually come with huge drawdowns, they're not repeatable, and they collapse once capital scales. It's like when we see multiple payouts from these prop firms. The only thing you should concern yourself with is how much has that person spent on prop firms. If they've had 50K of payouts, but they've spent 30K, that's not a particularly good return. If they've had $7,000 or $8,000 of payouts, but they've spent $500, that's a phenomenal return. And the trader who makes 15% for 15 years with modest drawdowns will be far more respected in this industry than the one who makes 80% one year and blows up the next. So having your expectations in line is really crucial. And a lot of people don't want to hear this stuff, but this is what real trading is. Now, one of the biggest issues that I see with traders that I coach or students is that They think that they're not profitable just because of their technical analysis. The trader that I just mentioned that achieved the 36% return, if they were to show you their edge, you wouldn't believe how simple it is. My edge is incredibly simple. I'm just trading basic supply and demand levels outside of recent structure with cross-asset alignment. It's really basic. And I know traders that just trade basic support and resistance zones, multiple touch levels at positive risk reward, and are achieving that 20-30% plus per year. You don't need a really complex model. You just need something that consistently performs, and you need to show up every day and execute it. So your goal for the next 12 months is just to define a basic edge. I'll show you mine, and then stick to it for 12 months. I see so many traders strategy hop. Sometimes my system can generate 8 trades in a month, 10 trades in a month. Another month it might generate 1 or 2. The issue for a number of traders is that they cannot sit on their hands when the market is quiet. But if your edge isn't present, you don't have an edge, and there is absolutely no need to execute anything in the market. The novice trader tends to think that they're missing out. They see social media and these crazy results. They naturally start to deviate, strategy hop, or tweak the edge, and inevitably they never find consistency. I've known of traders that have been repeating this pattern for 5+ years, and they've never got anywhere. They're always looking for the holy grail system. And the holy grail system isn't flipping accounts or max risking prop firms. The holy grail is in probability. It's in finding a system that generates a positive expectancy and just executing it robotically and motionlessly over time. So for 2026, no more shortcuts. One strategy for the next 12 months. Don't deviate. Your strategy needs to be backed by data. If you don't have one, backtest mine. And your goal is to make 2 to 5% per month, realistic expectations. Now, if you hit 5% per month, that's 60% annually. Even that is an unrealistic return. And the likelihood is you're going to have losing months. But the goal is to continue to execute regardless of the outcome. Focus on the process. The outcome will take care of itself. So what is an edge? Well, there are 3 elements to an edge. There's a technical, there's your position sizing, there is a psychological edge. Now the technical, it's very, very simple. It's just something that works more than it doesn't. Or it's something that when it does work, it makes more than it doesn't. That's positive risk reward. But it has to be data backed. How do we know how it's going to perform in markets coming up if we have no data on how it's performed previously? And if you don't have data, spend time backtesting. You can build data. The system has to be rule-based. If there's loads of discretion and you're not an experienced trader, you're not going to find consistency. You need to follow a black and white rule-based process so that you can execute efficiently with a positive expectancy. Why is position sizing important? Well, it's important for a few reasons. One of them is risk tolerance. So if you know your data and you know your system is likely to hit 5 losing trades in a row, then what percentage do you need to be risking per trade to not go on tilt, strategy hop, and deviate? Knowing your data is hugely important because this allows you to position size correctly. But the other thing is to know your goal. Is your goal to manage a fund and make 20% a year? If so, you position size accordingly. Is your goal to pass a prop firm challenge in 1 month? Well, this is where you have to understand the max drawdown parameters of that firm, as well as the profit target, and position size accordingly. And if you know your setups and you know your win rate, the percentage of certain setups working, then you can position size on those higher probability setups with bigger size and smaller size on the lower probability. The last element is psychological, and this is the bit nobody really works on, but to show up every day with emotionless execution is difficult. I've probably read Trading in the Zone 10 times. I constantly do work on my psychology. I meditate before every trading session. I review my data continuously, and I make sure my mind is right and I'm fully grounded before going into the trading session. I perform a psychological review every Friday of the week just gone. Are there key things that are coming up that I need to work on? All of these processes make me a profitable trader. You want to try to eliminate as many discretionary decisions in your trading as possible, because these can really impact your psychology. You could be overconfident, size up too much on some of these discretionary decisions, or you may lack confidence and fear and freeze when the moment comes to click the button and enter the trade. Another key thing with your psychology is your risk tolerance. Understanding your max drawdown, understanding the risk tolerance from your position sizing perspective, as well as your psychology, is really important. knowing what your max consecutive losses are likely to be, knowing what your average consecutive losses are likely to be. This will stop you going on tilt when they do happen. And the last thing is routine. As part of your trade plan, you have to have a solid routine. You have to be up at the same time every day. You have to be doing your pre-market review. You have to be doing your meditation if that's what you need to get your mind right. You have to be doing your psychology review, journaling your data, reviewing it periodically. All of this forms part of a larger routine that will push you towards success and profitability as a trader. And every part of this should be part of your trade plan and your trading journal. Your journal is for collecting data. Your trade plan is to give you a process that you need to follow before executing every trade, to manage every trade, and a routine to follow to show up at the same time every day and execute efficiently. So what should your trade plan consist of? Well, firstly, you need to consider what instruments you trade. You trade one instrument at the New York Open? Fine, focus your energy on that. Personally for me, I trade the FX majors, I trade some commodities, and I trade some indices. And I have a basket of around 15 different markets I'm looking at any given day. A key part of my routine is setting alerts because I can't monitor 15 different instruments continuously. So I need to know when alerts go off, what I need to do. The technicals for me are really simple. They're daily time frame supply and demand zones. I do use the H4 as well. My traders that are busy with 9 to 5s typically trade the daily time frame. And I recommend you guys do the same for the next 12 months. The higher time frame typically carries more weight and the levels are more likely to respond. And for the purpose of collecting data initially, just trade every setup at 1 to 2 risk reward with a 15 pip stop loss. That's across the FX majors. Adjust it accordingly for your commodities and indices, but try to start executing mechanically. If you need to change that, go for a 1-to-1 risk reward. You're going to have a higher win rate. Having a new trader trade at positive risk reward initially always helps them understand probability over time, and they get to see it in action. Okay, so let's go through some very basic charts and how we translate that plan into an actionable process in the markets. Now we know that we're looking for daily supply and demand zones. This is a pound US dollar chart. There is a trade that we took last week in this area of supply, and I'm also going to cover this trade that we took in an area of demand. Now I've simplified the levels because they are refined zones on the 4-hour. If you simply look at how price drove into this area of supply on pound US dollar last week, you can see that we had an instant reaction to the zone. We tapped into the lower part of the zone. That's where I recommend you trade from. And with a 15 pip stop loss and a 30 pip target at 1 to 2, this trade was a very quick winner. Within 4 hours, it had played out. This is the most basic edge that I could teach, and it's exactly how I trade. I trade basic supply and demand zones with cross-asset correlation. If you don't understand cross-asset correlation, download my free PDF under this video, where I comprehensively go through how assets align to make these zones higher probability. What about this zone here? When we tapped in, it looks like it's breached and failed, but let's set the trade up because I know full well that this was a win for me. 15 pip stop loss and a 30 pip target. Go down to the 1 hour and you can see again this trade was a quick win. Now all of this needs to be journaled. You have to start looking at what was your max adverse excursion, so what drawdown did the trade do? What was your max favorable excursion, as in how far did it go without you after you took your profit? Measuring all these variables will allow you to optimize your strategy. Something that I find is a lot of traders are expecting too much from levels like this. Yes, it's a daily area of demand, so it's a big zone. But a lot of traders will set the trade here, they'll put their stop loss here below the zone, and they'll target the next area of supply, say here. So this body area here, this body close here. That gives a 1 to 1.5 and it completely lost. We already saw a reaction from the zone. The zone held up. We were correct in our analysis, the trade played out and we made money. We don't need to be looking at the market for these huge swings and moves. That requires a big shift in fundamentals. That requires a full change of trend on the lower time frames like the 4-hour. But with smaller parameters, we're able to just take our piece of the pie and move on to the next trade. A friend of mine once said, there's $8 trillion traded in this market every day. We don't need a slice of the pie, we just need a crumb. And that couldn't be more true. So defining a basic edge is really important. Your edge is going to come from your patience, waiting for the setups, and also showing up for 12 months and executing it the same way in a repeatable fashion. Not deviating, not tweaking, not strategy hopping. Avoiding social media, avoiding these marketers that are telling you that you need to trade Asia liquidity sweeps and breaks of structure every single day. Like I said to you, I know a trader that's managed a fund this year at a 36% return who has just simply found levels that are multi-touch zones in the market. For example, this one here. He would look at this level being reactive several times previously. He tries to take an average of the multi-touch zones, and then he will trade these levels when we retest them. It's as simple as that. These overcomplicated strategies perhaps are better suited to prop firms where traders are just gambling, taking max risk, and rotating through accounts. Like I said to you guys, the only stat that really matters is how much they've spent on the accounts versus how much they've made. And all these restrictions on prop firms are one of the reasons why I prefer trading personal capital or live capital over prop. Now, the final piece of the puzzle is your journal. This is hugely important. You have to journal every single trade. But you can see here that I've been executing at a 71% win rate. It's very hard to market this on social media and market my mentorship because people aren't particularly interested in a 25% return on the year. What sells is saying I could flip $100 to $1 million or flashing absurd payouts on prop firms. But the reality for me is this is a career. Within 3 years, I'd like to have a family office and be managing my own fund. And to do so, I need to be a good risk manager. And I aim to make 20 to 30% per year. That's what real trading is. And over those 42 trades, you can see that the total sum is 30.44R. At 1% risk, that 41 trades would generate a 30% return. At 0.5% risk, a 15% return. But you guys can see that this is real trading. It's realistic. My goal for 2026 is the same. It's to make 20 to 30% over the year, show up, execute robotically, and look for 2 trades per week. On average, that's what I'm looking for. I'm not sitting glued to my screens for 8 hours a day. I'm not showing up just at New York Open to high leverage a position. I'm just executing a robotic process over and over. And if you want to be profitable in 2026, I recommend that this is what you do. And if you want to execute with a profitable trading community of humble, non-ego driven traders, then join my Discord below, drop me a message, and we'll get you onboarded onto my mentorship. Thanks, guys.